So now we can start.
Yeah, so we'll just wait for a couple of minutes for attendees to come in and then probably we'll start. So in the meanwhile, I, on behalf of Women and Young Members Excellence Committee of ICI, welcome you all in the Youth Excellence Symposium number 13. Youth Excellence Symposium is a Friday series of program conducted by the committee for the women and young members. It is one of the Women and Young Members Excellence Committee's initiative to not only disseminate information to members on technical updation, but also to empower and inspire them to come at the forefront and realize their verbal skills at public forum. So we generally have young speakers coming in and addressing the young audience. Uh, Today we have young and dynamic speaker CA Parth Savla, who would be covering session on ESOP structure for key employees. I also welcome the coordinators for today's session, CA Pratik Jaju, CA Hetal Gada, and CA Ashay Dedia. So I think in the meantime, Chairperson CA Preeti Savla and CA Abhay Chhajed joins in. Till that time, I request CA Parth Savla to please start with the today's proceeding. Before that, I request Ashay to please, Pratik Jaju to please introduce the speaker for today's session.
Yeah, thank you, Gautam. I, Pratik Jaju. Good evening, everyone. So Parth is currently working with PwC in direct tax team. He was earlier associated with the Dhruva Advisors and LLP in the similar role. He is a merit holder chartered accountant with the 12th merit in CA final. Parth participates in the field of domestic and international tax and has versatile consulting experience across the spectrum of direct tax, international tax, deals tax, ESOPs, designing corporate laws, and exchange control regulations. So without taking much of time, I hand over to the Parth to start the today's session.
Thanks, Pratik. Just before Parth starts, in case any of the audience wants to be coordinator or speaker for this initiative, Friday series initiative, they can reach out to the committee and we can have sessions planned according to the suitable time and availability. Yeah, thanks. Parth, you can continue with your session.
Yeah. So, hi, good evening, everyone. First of all, I would like to thank the ICI for providing me an opportunity to share my thoughts on structuring of employee ESOPs for key employees. What we'll be doing for the next 90 odd minutes is that we'll be discussing the ESOP framework right from the basics to understand certain commercial aspects which are relevant, certain key terms which are important in understanding what the ESOP philosophy is, and slowly moving on to the tax and regulatory implications from an India perspective, which one should be aware of while designing and implementing a specific ESOP scheme. So without, with this background, what I'll do is I'll directly jump on to the relevant aspects. In recent years, recent times, it has been seen that ESOP is the buzzword, especially for the startup India, and we have seen that host of companies, be it large, medium, small, have remunerated or issued ESOPs to its employees. So therefore, one really wonders what these ESOPs actually are. Are they merely some instrument on paper, or are they something which will be adding value not only for the employees but also for the company as a whole? And we have series of examples, a host of countries, a host of companies across the length and breadth of sector and across the length and breadth of the size through which they are operating, have issued ESOPs. And no wonder ESOP, the concept of ESOP is not new. Its origin could be traced back to some good old days where Microsoft was probably among the first few companies which had implemented ESOPs. So ESOP as such, from at least the concept perspective and from an implementation perspective, has not been new. It has been prevalent since decades, and from an India context as well. Though the philosophy of ESOP would have picked up in recent years, in a recent decade or so, but from an India perspective as well, the concept has not been new, and it has been implemented and tried and tested several times. So this is a famous quote from Mr. Bill Gates in one of his books, The Road Ahead, where he has acknowledged that the shared ownership through stock options that the company Microsoft had offered to almost most of its employees at that point of time has contributed immensely to their success than that what they would have predicted. So, right, the ESOP philosophy is something which has been is not new, and it has been tested time and again. So that brings us to the question, what is ESOPs? As I said, we'll be starting through the basics. So here onwards, I'll take you all through what basically an ESOP means. What are its very basic terms that one should be aware of while understanding the risk and rewards that are associated with ESOP. So basically, employee share ownership plan, as the name suggests, is a plan for sharing ownership with your key employees or with your with employees to achieve desired objectives. So as such, it is an incentive or a tool or a measure of reward or performance which is given by a company to employees, which enable and creates ownership linkages. In a traditional model, we have always seen that the entrepreneurs are the one who are the shareholders of the company, who reap the benefits of whatever value creation happens. But in an ESOP, typically a share of the pie is also given to employees, because at the end of the day, we all realize that human capital is probably the most valuable asset that a company can possess. So might as well share some part of your ownership with the employees as well, who create, who participate, and who provide you significant growth opportunities. This is a classic example of why an ESOP has been the most popular mode of incentivizing employees as well as ensuring wealth creation. And if you would see on the left hand side, is I've tried to depict it that if the company of if the size of the company before ESOP is say 1x, potentially once ESOPs are granted, which creates ownership linkages, even the employees feel more motivated and more aligned with the objectives of the company. And because of a motivated workforce and committed employees, you would rather see that the value of the company has increased manifold. And in spite of sharing a certain portion of the cake or pie with the employees, you would realize that at the end of the day, it's the founders or the promoters or the entrepreneurs who have also benefited by and large. So as such, this is a key philosophy of ESOP, where it acts as a wealth creation tool, not only for the employees, but also for the company as a whole, because the size of the company per se increases manifold. A basic question, which comes up is why ESOPs and why not direct investment? Why can't I make a direct investment into the company and claim same sort of ownership linkages and entrepreneurship which otherwise somebody else would be owning? So this slide discusses typically how a normal investment in a company vis-a-vis ESOP is different, and what are the things which can be distinguished per se from a standard investment template vis-a-vis the ESOP model. So in a standard investment model, obviously, we all know that investment in private limited companies or unlisted public companies is not so straightforward, and generally the ownership is among a few set of people who drive the company and or the investors who have invested the money into the company. So per se, at the threshold itself, opportunity for employees or other personnel to invest in the company is limited, unless you are familiar with the promoters or other key investors who can provide you an opportunity. So regardless of that, if at all there is an opportunity that arises for investment, in a standard model, what one will see is that you upfront invest your capital by acquiring the shares of the company, which ensures that at the current stage itself there is a sacrifice, as also certain uncertainty and risk associated of investing in an equity. So per se, the standard model is straightforward. It involves current sacrifice, investment in shares, with probably risk and rewards linked to ownership. Whereas if you distinguish it with an ESOP model, as such, at the start when the ESOPs are granted, you don't have to shell out money upfront. It is only options, as you typically call it, and we'll be discussing a few slides later what do you mean by options, is what you acquire. So in simple words, option means the right to buy, right to acquire securities at a future point of time. So at this stage, what you get is only an option to buy shares, and therefore this ensures that at the current point of time there's no existing investment or cash flow that one has to make, which also ensures that since there's no money that has been invested or no skin in the game, as we call it, there's no current sacrifice. But indirectly, you are entitled to future value upside because you have a right to acquire securities at a predetermined time. And therefore, from a risk perspective as well, this is, so to say, a little bit diluted because you will exercise the option only when you see a future potential upside or if the option is in the money. There could be various reasons, as I have discussed, that why ESOPs could be issued. Obviously, the basic objective is to ensure a wealth creation opportunity to align the objectives of the company with that of the employees, and create a common pipeline and vision vis-a-vis the future growth of the company is concerned. So as such, long story cut short, while there will be several reasons while one may issue ESOPs, but at the end of the day, it's a win-win for both the company as well as the employee, who share a common vision and growth for the company by taking respective share in the pie. Now dealing with the specifics, having understood what ESOPs are and why they are issued, let us deep dive into the specifics of the types of employee ownership plan which are prevalent, and amongst them, which are the ones which are popularly followed in India. So by and large, the concept of employee ownership plan as such is not something which is getting derived from any statute or any law which provides you the different types of employee ownership plans. It is commercially negotiated between the parties, especially the company and the employees. Over the years, what one has seen is that there are some plans which are more popular compared to the other, and there is limited guidance available as well from a statutory perspective of what could be the counters of those plans. To start off with, the most popular employee ownership plan is the ESOP, as we call it, and the full form of that is Employee Stock Option Plan. So we'll be spending some time on this because this is the most important plan, and it will be very important that the basics of this is understood crisply, so that once we move on to certain implications, we can correlate the facts and the background for ESOP. So as I said, the ESOP involves grant of options, wherein pursuant to the option that the employee is holding, he gets a right to acquire the shares of the company at a future point of time. So as of now, at the point of time when ESOPs are granted, what the employee gets is only a right, only an option to acquire the shares in the company, but the price at which he would be acquiring would be fixed and determined upfront itself. So where options are issued and say that has a period of 4 to 5 years, even when the shares are proposed to be exercised after 5 years, the employee will have the right to buy it at the price point at which it was agreed on day 0. So you have a right to buy, not an obligation to buy. The price at which you will be buying is logged and it's fixed upfront. And Obviously, since this is an instrument which is a dual objective of ensuring a win-win for both the company as well as the employee, there are certain conditions which generally are associated when the options get vested and eligible for exercise. And we'll be discussing those terms in a minute. But broadly, ESOPs, as to summarize, is an option, a right which is granted to the employee to acquire shares at a future point of time at that price point which is determined upfront, and there is no obligation to buy. Obviously, it is subject to fulfillment of certain conditions. On the other hand, the second plan, as is called ESPP, which is Employee Stock Purchase Plan. Compared to ESOP, this is a complete opposite, where instead of granting options, you grant the shares itself upfront to the employees. Obviously, to ensure that the conditions are fulfilled, there are certain lock-in restrictions and other conditions which are enforced upon the employee, so that indirectly the vesting conditions are back-ended with this restrictions on lock-in and other conditions. This is ESPP ensures a skin in the game right from day one. The cons which are associated, as we understood in the earlier slide, for a standard investment model, all of those typically apply to a ESPP as well. But there may be several commercial reasons why one may want to issue ESPP compared to ESOPs. Third one, and again, the second most popular instrument, at least from an India perspective, is stock appreciation rights, or also called as phantom equity. Now, in a stock appreciation rights, and the other word for that, phantom equity, the name itself suggests that phantom means notional. So there is a grant of notional units which are issued to the employees. It's akin to a deferred compensation plan where the benefits of the employment vis-a-vis the ownership are based on the performance of the company and appropriately remunerated to employees at a later point of time. So very similar to ESOPs, except for the fact that instead of options, notional units are granted. These units are linked to certain it could be linked to anything through which the performance of those units might get tested. For example, those units can typically be linked to the market price or the prevalent FMV of the equity shares of the company whose rights are being granted or whose units are being granted. And at the time when these units are encashed, generally what we have seen is that there are two modes of encashment or two modes of settlement. One, we call it as a cash settled SARS or cash settled phantom units, or other could be equity settled. So at the point of time when these units are encashed, it could generally the terms would provide that whether this would be cash settled or equity settled, and this is how ultimately the units will get settled. RSUs, I will not deep dive much into it. Those are typically restricted stock units, not very popular in India. As I said, ESOPs and SARs are the two most popular instruments, at least from an India perspective. So our focus on the next slide would be to discuss and deep dive into the specific aspects of ESOPs and SARs. This is a high level comparison of certain key factors vis-a-vis risk, cash outflow, and future upside for employees, qua different types of plan, and based on which based on the exercise price that one generally associates with the plan that has been issued. I'll not discuss this. I'll be sharing my slides, so maybe at a later point of time this can be referred. Yeah. So this is, I think, the heart of the ESOP philosophy. The key terms which are relevant, where one needs to understand of how an ESOP life cycle is. So it starts from the grant date or the date on which the grant is made. So grant is a promise or an option which is given to an employee, which specifies that employee has to fulfill certain conditions. Upon fulfillment of those conditions, the options will get vested, as we call it, upon the employee. And once the options have been vested, employee will have a right to exercise it within the exercise period. So three terms which are very, very important. First term is grant, second term is vesting, and third is exercise. As I said, grant is the date on which the options have been granted. At this point of time when the options have been granted, it's subject to fulfillment of certain conditions. Options cannot be exercised generally until those vesting conditions have been fulfilled and the vesting period is satisfied. So this ensures that the instrument of granting the instrument granting ownership rights comes also with certain performance related conditions or certain other time based conditions which the employee has to fulfill, which again acts as a win-win for both the employees as well as the company, and ensures a long term commitment from the employee. Those conditions, as I said, which needs to be fulfilled, could be either time based conditions or performance based condition. And when I say time based conditions, typically due to passage of time, how the options may get vested over a period of time, as in when the employee completes specific period of employment. Performance based condition could be more specific, dynamic, relevant to the industry level, relevant to the level at which the concerned employee is working. But yes, vesting conditions are like very important, which enable the employee to claim a right to exercise the options. So once the vesting conditions are fulfilled, we say that the options have now been vested, which would mean that now they're eligible for exercise by the employee at their discretion. And typically the period between which the employees can exercise the option is called as the exercise period. It's upon this event of exercise that the options get materialized and are converted into equity shares, where now at this point of time when the options are exercised, the employees are allotted shares and the employees also become the shareholders of the company. And as I said, this life cycle could be long, starting from grant date till the exercise date. And on the event of exercise, the price at which the shares will be allotted would be determined on the grant date itself. So it would be issued at the price point which was agreed, typically called as the exercise price. So this is just to summarize what I discussed in my earlier slide. This is how typically a ESOP life cycle could look like, where on day zero, grants are being made. Say let's take an example that so that we are clear about the concepts. And as I said, I want to spend more time on this slide because this is the heart of the understanding all the related consequences that we would be understanding. So say 10,000 grants or 10,000 options are made on day zero, which will vest proportionately over a period of 4 years, which would mean that it's a time-based vesting condition. 2,500 grants vest each year over a 4-year period, and once the options have been vested, they will be eligible for exercise in accordance with the exercise period. So this is an example where there is a proportionate vesting over a period of time, and on completion of each of the event or each year, the some or part of the options are vested, and all of the options get vested at the end of 4th year, after which or proportionately would be the complete vesting would get completed, and exercise can be made from the point of time when the options were respectively vested. Yeah, and sorry, the last part, if the options are not vested, not exercised within the exercise period, we call it that with typical term that is used is lapse. So the options lapse and they shall no longer be eligible for converting into equity shares. So that brings us to the question, to whom do we offer ESOPs? Who are the people who are eligible for being issued ESOPs? And generally from a commercial or a practical perspective, how do we ensure that who are the people to whom we should be issuing ESOPs? The second part of it is slightly more complicated. First part is fairly straightforward. There's a guidance available under the company law as well as SEBI. SEBI regulations are applicable only in case if the company is listed entity, If the company is an unlisted entity, be it a public limited company or a private limited company, the Companies Act regulations will be applicable. So from a Companies Act perspective, the law is fairly small. There is only one rule which governs the entire framework for ESOPs, which is very simple, very straightforward as such, if not simple. So as such, as I mentioned, in my earlier slides as well, the law and regulation relating to ESOP is comparatively lesser. It's more to do with how practically and commercially you want to negotiate your terms. And from a Companies Act perspective, the employees, it has been clearly mentioned that ESOPs can be granted only to employees. And employees have been defined in a particular fashion or in a particular manner, which includes employees of the company, employees of the subsidiary company, as well as employees of the holding company. So ESOPs of a particular company can be granted to own employees. If there is a subsidiary company, you can grant your own ESOPs even to the employees of the subsidiary. And if you have a holding company, you can grant to employees of those holding company as well. There are certain exceptions which have been provided at who would not qualify as an employee. Two specific carve-outs. One are promoters. You cannot grant ESOPs to person who qualify as promoters. And second are independent directors. Obviously, independent directors cannot be granted ESOPs because that will jeopardize and affect their independence. And at the same time, generally, we see that independent directors are not employees, don't work full time. But even if at all they are working full time, they are not eligible to be granted ESOPs. So Companies Act bars grant of ESOPs to specific persons being an employee who is a part of the promoter group, and to independent director. And the third one is to other directors who are holding more than 10% in the company. From a SEBI regulation standpoint, almost similar definition, just two exceptions. From a SEBI regulation standpoint, apart from grant of ESOPs to employees of the holding and subsidiary, ESOPs can also be granted to employees of the group company or associate company. At this point of time, there is no corresponding amendment that is made under the company law. So while the SEBI regulations do allow you, as I said, it is applicable only to listed companies. For unlisted companies, you continue to be governed by the company law. And even from a listed company standpoint, there is some sort of difference in the eligibility criteria vis-a-vis the company law and from a SEBI perspective. But here the better view would be that the SEBI regulation should prevail over the company law. This brings us to the commonly followed practice and the million-dollar question: to whom are ESOPs generally granted? So as such, it is discretionary completely. To discretion, at the discretion of the management, at the discretion of the promoters. Generally, what we have seen is that ESOPs are issued to key executives who are following part of the top or senior management, who drive the vision and growth of the company. Having said that, it's not mandatory that ESOPs can't be granted to a middle level or lower level employees as well. There are some instances where ESOPs have been granted to several lower level employees as well, who may have, say for example, a long history of being associated with the company for say 15 years, 20 years. So typically we call it as a long service award. So ESOPs can be granted to those employees as well. So law is very flexible. You have complete discretion to issue ESOPs as long as you qualify within the definition of employees provided under the law. Again, an important question: how much to offer? How do you determine what is the quantum of ESOP that need to be granted? Again, the law does not provide any guidance on this. There are certain approvals that may be required if options have been granted or ESOPs have been granted above a specified threshold. But there is a complete flexibility that is available under law to determine the quantum of grant that can be made or quantum of ESOPs that can be issued. Obviously, then it is left to the discretion of the management of how much is offered. And there are various factors which are considered. Illustrative are listed in the slides in my current slide. There may be several other factors as well which may affect the the quantum of option that have been granted. 2-3 important parameters. Obviously, one is the seniority. of the employee, which determines the quantum of grant that needs to be made. His existing salary levels or salary grids at which he is currently placed, and the criticality of that employee vis-a-vis the function or the team that he is leading or he is a part of. So various factors are there. There may be several other factors as well. In startups, it is quite common to grant ESOPs to members who are part of the tech team, who drive the company as well as the products that are listed. So as such, it's fairly very complex and complex process to and a difficult task, to be honest, to determine how much of grants to be made, because this directly affects the proportion or the dilution vis-a-vis the existing promoters. So higher the options that have been granted, higher would be the dilution vis-a-vis the existing shareholder. So determining how much quantum of portion needs to be given is, so to say, important decision-making point. Again, as there'll be quite a few moving pieces when ESOPs are being discussed, because commercial aspects drive ESOPs more rather than from a tax or regulatory perspective. And there are certain important other decision making points as well, of what should be the grant price at which it should be made, what should be the grant strategy, what should be the vesting conditions. So in this slide broadly captures few aspects which would be relevant. Vis-a-vis grant price is concerned, it is generally being benchmarked to the ruling price at which the options are being granted. So say, for example, if I am being granted ESOPs of A Limited, which is engaged in tech business, I would typically what one would see is that the prevalent FMV of the equity shares of the company is the price point at which the ESOPs would be granted. Having said that, there is quite a possibility that the ESOPs may be granted at a moderate discount to the current FMV as well. And as I said, then the law provides complete flexibility to determine the grant price. One very important and a basic question comes is, if the ESOPs are granted at the ruling market price, what's in it for the employees? And if one were to think about the philosophy of ESOPs in a much more detailed and a reasoned manner, the answer is that even if the ESOPs have been granted at the current market price, it's the future value it's the potential future value upside through which the employee may stand to gain. And as I said in my earlier slide as well, the value of ESOP, or the exercise price of the ESOP remains the same over the entire vesting period until the point of time the exercise is made. If the exercise is made, say 5 years down the line or 6 years down the line, where the price of the company would have increased 4 times, 5 times, I will have a right to exercise the shares at a price point of 100 at the point of time when it was granted. So even if the ESOPs are granted at a ruling market price, it's not that the ESOPs are valueless. It's the future upside or the future potential which one has to look at while determining whether the options are valuable or not. From a grant strategy perspective, it's again very flexible. There are some companies which give a one-time grant. There are some companies which give timely grants as well, and there are some companies which give a combination of a one-time grant and a yearly grant. And when I mean a one-time grant, it means that generally ek bar ESOP de diya, and that's the end of story. But this is not how typically businesses and company and employees grow together. You need to keep your employees motivated over a period of time. So generally a combination strategy is generally what is being preferred. That if you want to give 100 ESOPs to employees, don't give all 100 at one go. Plan it over a period of time so that there is a skin in the game and a mutual vision for both the company as well as the employee. Vesting conditions could be anything. Typically, time-based vesting condition is the most popular one. That could be performance-based as well, where the grants are linked to the performance of the employee of the respective division or respective sector or respective team which the employee is part of. What are the modes of implementing ESOPs? Generally, in India, two routes are there. One is a trust route, and the second is a direct route. The trust route is fairly complex, wherein employee beneficiary or employee welfare trust or ESOP trust is formed, which acquires shares from the company at a predetermined price and grants options based on the share that it is holding to employees. So as such, trust root is something which is fairly complex. There are certain reasons mainly from a commercial perspective that trust root is followed, and from a structuring perspective, what one has generally seen is that where ESOPs are to be granted to non-employees, this route could be explored to fit or to ensure that the regulatory uncertainty can be whether it can be dealt with appropriately by some structuring. So generally, if it's a straightforward case where options are to be given only to employees, a trust structure has a lot of complications and a lot of tax and regulatory calls to be taken. And vis-a-vis that, when ESOPs are issued through a direct route, it is fairly straightforward and simple. And what do you mean when ESOPs are issued by direct route? It simply means that there is no additional entity or a structure which is created for the grant of options. It is the company pool itself which is used. It is the company pool itself which is used for grant of options, where at the point of time when options are granted, it's a potential equity which is reflected in the balance sheet, and at the point of time when the shares are exercised, at that point of time, the equity dilution happens and the shares are issued. So there are several aspects, which are highlighted, which one needs to factor while decision making, and each of these factors have detailed nuance around it. So obviously, it's the big decision to be made whether to implement the ESOP through direct route or to implement the ESOP through the trust route. Yeah, so one of my colleagues recommended that I uh, take a pause, after having explained the basic terms of ESOP, because now I will be deep diving into the technical aspects, and if hoping that at least till now the basic concepts are clear. So because now we're going for a fun ride where I'll be taking the group through certain myriad of tax and regulatory laws that are applicable in India from a ESOP perspective. So so far we have understood how ESOPs work, and let's move on now to the next slide, which will be discussing the tax and regulatory framework governing ESOPs. Broadly, several laws and regulations are applicable while dealing with ESOPs. Two baskets. One is from an employee perspective, or what are the conditions and regulations that are to be complied with, and second is from an employer perspective, what is the eligibility criteria, to whom ESOPs can be given, to whom it can't be given, and certain related conditions around it. So broadly speaking, this is the basket of laws and regulations that are applicable in India vis-a-vis ESOPs. Company law is one. For listed companies, there could be other laws, SEBI regulations as well, which would be applicable. Three commonly affected regulations are SEBI share-based employee benefit regulations, SEBI ICDR regulations, and SEBI PIT regulations. And when foreign persons are involved, either a foreign company or an employee who is a non-resident, one would see that even FEMA regulations become applicable. And last but not the least, something which is always certain are taxes, and the tax implications as well from an employer and employee standpoint become evident. So what we'll be doing is first we'll understand the tax implications, understand the host of issues which one has from a tax perspective vis-a-vis employees as well as the employer, and then we'll touch upon the regulatory implications as well of what are the compliances and what are the eligibility conditions to be fulfilled. To start off with, tax is something which is very, very critical in decision making. As I said, ESOPs are not something which is a tax planning tool. It is a tool or a mode for rewarding employees and ensuring that there is a win-win for both vis-a-vis the growth of the company is concerned. So it's a value or a wealth creation tool, not something which is being given from a tax perspective or from a tax planning perspective. Having said that, it is obviously important that one understand the contours of the tax implications that can arise from an employee standpoint as well as from an employer standpoint. So first section deals with tax implication in the hands of the employee, where I'll be taking you through host of issues that will come up vis-a-vis employee taxation is concerned. Well, it may seem fairly straightforward, but when encounters practical situation, we could realize that it's not so straightforward. So to start off with, a small and a simple depiction of what is the price, what is the time or the point of taxation vis-a-vis ESOPs in the hands of the employee. So as I said, there are 4 stages typically which are associated. First is grant, second is vesting, third is exercise, and fourth is sale. So income tax regulation, income tax law as it stands today is very clear that tax implications in the hands of the employee will arise only at the time when exercise happen and consequently shares are allotted. So there'll be no taxation in the hands of the employee at the point of time when grants are made or at the point of time when vesting happens. It would be only on the exercise followed by consequential allotment at which the taxability would arise in the hands of the employee. And this would be regarded as a perquisite in the hands of the employee, taxable under section 17 subsection 2 clause 6 of the Income Tax Act. So this income would be taxable as a salary income, taxable, and since it would be taxable as a salary income, the base rate that would be applicable, base tax rate that would be applicable on this income would be 30% plus surcharge and cess. And if one were to factor surcharge and cess, the tax rate could go as high as 43% or 39% in case of one is adopting for a new regime. But ESOPs as such, when exercised, could potentially lead to a 42% tax in the hands of the employee. So one really wonders if what is the value that at the end of the day that the employee would be getting, and the answer to that would be the remaining 58%, which are saved, which are not given up in the form of taxes. This is the first point of taxation where salary income is generated or taxed, and this is at the point of time when the options are allotted. And after the options are allotted and shares have been acquired, one would see that they would be sold in the market or to third-party investors or to somebody else at a future point of time. So this may result, and this will result in a capital gains tax implications. Now, where the capital asset, which is the shares which was acquired pursuant to the exercise of options, has now been transferred. So the difference between the sale consideration and the cost of acquisition of the shares, as adjusted by some mechanism which has been given, will be regarded as capital gains and will be subject to tax as capital gains. And the law in India, the tax rates in India for capital gains, we are all aware of, depend upon short term or long term. If it's short term if it's long term in nature, again it would be dependent upon whether the shares are listed or unlisted. So potentially in case of listed securities or listed shares, the tax rate would be 10%, and vis-a-vis the unlisted, it could be 20%. So two points of tax. One is at the time when the shares are issued or shares are allotted, that income would be regarded as salary income, and the upside income over and above what has been taxed would be regarded as capital gains, and that would arise at the point of time when the shares are sold. How do you compute perquisite income? And that's again very important. And the income tax law does provide certain guidance on how do you compute perquisite income. The law is very clear that the fair market value of the equity shares on the date of exercise will be regarded as the full value of consideration, This is as per Rule 3, Sub Rule 8 of the income tax rules, and they will allow you a deduction, so to say, of the amount that you have actually paid to acquire the shares as a deduction. The net income would be taxable. So to take a small example, which has been mentioned on the right hand side of this slide, say in 2017, some options were granted. 10 options were granted where the exercise price per option was 100, or exercise price per option was 100, and there are certain vesting conditions which were attached, and the vesting conditions got fulfilled on 31st of March 2021. And the exercise happens a year later in June 2022. So the question would be, what would be the point of tax? And as we have discussed in our earlier slide, the point of tax would be the event of exercise and consequential allotment of shares. So June 2022 would probably be that point of tax where the income would be taxable as salary income, more specifically perquisite. How do you compute that perquisite? The fair market value on the date of exercise, which is 250 in my example, minus the exercise price, which is 100. So 250 minus 100 rupees, 150 per share represents the perquisite income, multiplied by the number of shares which have been granted will determine the total income, total salary, that is the total perquisite income that would be taxable. So fairly straightforward, fair market value on the date of exercise minus the exercise price will be taxable as perquisite. And as I said, the tax rates could be as high as 42% depending upon the bracket in which the employee is falling. So how do you compute capital gains at the subsequent point of time? The capital gains are computed at the point basis the sale consideration that accrues on transfer minus the cost of acquisition. So here the law does provide that while the actual cost of acquisition, as referred in my earlier in this slide, is that even though the actual cost of acquisition is 100 rupee, since on one additional 150 perquisite tax has been paid, the law allows you a cost step up, as we call it, for the income that has already been suffered tax as perquisite. So 250 would be the cost of acquisition of the equity shares that would be available. This is because of a deeming fiction under section 49, which allows you to take a cost step up for the extent of perquisite income which has already been offered to tax. So only income over and above 250 would be liable to tax as capital gains, and that too in the year in which the options have been sold, or when the shares have been sold. Vis-a-vis period of holding is concerned, unfortunately, no period benefit or holding benefit is available until the point of time when the options were held. The period of holding would be determined from the point of time when the options are actually exercised and the shares have been issued. So there may be a situation where if the options which are exercised are sold immediately within a period of less than 24 months, it could result in a short-term capital gain. And if it's a short-term capital gain, we all know that in case of unlisted securities, again, the tax rate could go upwards of 30. So one will have to really plan the timing of exit, especially vis-a-vis shares, so that at least they qualify as a long-term capital asset and eligible for a concessional rate of 10 or 20%. Vis-a-vis okay, so again, from a withholding perspective, this is something which is very, very important. If you look at my earlier example, at this point of time, when the income is taxable as salary income, there's a 42% tax that could arise on the employee. And as we are all aware, there is section 192, where the employer is obligated to deduct TDS on the amount of salary income that is paid or credited or accrued to the employee. In case of ESOPs, there arises a very tricky situation because the benefit that accrues to the employee at the point of time when exercise happens is a non-monetary benefit as such. So therefore, from an employer standpoint, there is no amount that may be available for deduction, because generally in a cash benefit, what employer would do is it would deduct the TDS at source itself and only remit the balance amount. So here in such case, a question arises, how does employer do a withholding where a non-monetary benefit is being granted to employees? And that too, we are talking about here amounts which may be in crores. As you know, what one has seen is that ESOPs have emerged as the single largest compensation or wealth creation opportunities for employees. So probably we're talking of crores and crores of amount being regarded as a perquisite. And on top of that, if a 40% withholding is to be applicable, there are serious cash flow issues which one comes up with, especially if the shares are unlisted. So there are, especially if the shares are unlisted, because there will be illiquid, because the shares will be illiquid for it to be exercised, for it to be converted into liquid securities or liquid cash. So this remains something which is a common industry issue. And therefore the certain structuring needs to be done, to ensure that the taxable event in the hands of the employee arises only on the occurrence of a liquidity event, so that employee also has the liquidity to pay the taxes that will arise upon exercise. Now this we already discussed. Yeah. So to solve the problem which is associated with lack of liquidity on occurrence of on the event of exercise, under Finance Act 2022, an amendment was made to defer the payment of perquisite tax to a future event, and this was only and only for ESOPs which are received by employees of an eligible startup. The term eligible startup has been defined under the income tax law. Not very encouraging definition, because the thresholds that have been given under the definition of eligible startup are fairly small. So generally, most of the companies would not fall within the meaning of eligible startup, even though from a common parlance perspective, we may associate that this is a startup, but from the definition of what income tax provides, this may not qualify. Generally, most of the companies would fall outside the ambit of an eligible startup. Assuming if you fall, so the applicability of this section is fairly limited, but even assuming that if you qualify within the definition of startup, what does the law provide? The law provides that the payment of tax, which is a pain point for the employees as well as from the employer in and so far withholding is concerned, it will be deferred to the future event, and that future event is earlier of the following events: expiry of 48 months from the end of the relevant assessment year, which would mean typically, if you look at it from the end of the financial year, it translates to 5 years, or on the date on which the shares have actually been sold. This would ensure that the employee now has liquidity. So if he has liquidity, even he would have the liquidity to pay taxes that arise on exercise, or on the date of termination of employment. Obviously, if the employment is terminated, one would this trigger point gets this point of taxation gets triggered, and it would be taxable in the year in which the exercise had happened. So mind you, the amendment that has been made is a very tricky amendment. It only defers the payment of perquisite tax to a subsequent year. It does not change the chargeability of income in the year in which the exercise has been made. So section 17 subsection 2 clause 6 remains unamended. It is only the provisions dealing with the payment of tax, like self-assessment tax or collection of tax under section 192, deduction of tax, have been amended. So there may arise certain complications because if the exercise is happening after, say, if the payment of tax is being done after 5 years, one will really have to think and scratch your head to how do you give effect to the income how do you give effect to the income which was already filed and closed during the course of assessment. So only the payment of tax get deferred. The chargeability of tax continues to remain in the year in which the exercise happens. Again, from things are not so simple. Things are not so simple when it comes to non-resident employees. There are a host of issues and host of things which one has to evaluate. I have broadly listed down certain parameters that need to be tested for determining taxability in the hands of the non-resident employee. On receipt of income pursuant to ESOPs. And the complexities get more and the complexities get more stringent if one looks at the situation where an employee is a globally mobile employee, which means that he is just not resident in one country but is moving across countries as a part of his employment. So 1 year he may be in India, in the second year he may be in US, or in third year he may be in Singapore. So the complexities get more and more as we get into the taxability of non-resident employees, due to two reasons. First is because of the global mobile nature of the employee, and second is the time period that is associated with ESOP is also fairly long. It starts from the date of grant and it ends on the date of exercise. So typically one has to take a second. Yeah, sorry for that. Is my screen visible? Yeah. Sorry. Yeah. So in case of non-resident employees, as I was saying, that there are some complexities which are associated because of the longevity of the ESOP life cycle, as also the physical presence of the employee over the life cycle in different countries. So the question arises, who will have the right to tax that income? Whether India will have a right to tax, or it would be some other country where the right of taxation would arise, especially if the services have not been rendered only in India. But having said that, I have broadly listed down what would be the taxability as per the Act and what would be the taxability as per DTAA. As per Act, generally Section 9, which is a deeming fiction, which provides that the salary income of a non-resident would be taxable in India only if the services have been rendered in India. And the interpretation of the term services being rendered in India has been time and again given by courts to mean the physical place at which the services have been rendered. So the proportionate income, which is taxable based on the number of days stay in India, is generally taxable. Now, when you add ESOP to it, the things become complicated, because in an ESOP, actually, if you look at it from a commercial perspective, the income accrues from the date of grant or from the date of vesting to the date of exercise. It's only the date of the exercise date is only the point of time when the taxes are collected, but income is accruing over a period of time as and when the vesting conditions are fulfilled, and it's the last day, that is the date of exercise, on which it gets crystallized. So therefore the complexity gets added, that while the law provides that the taxability in India would arise proportionate to the services rendered in India, in an ESOP context, that gets really challenging. And another complexity that would arise is, how do you compute the perquisite value? Do you apportion it based on the number of days stay in India, or do you keep it aggregate based on the criteria that has been given under 17.2? From a treaty standpoint, one has to evaluate the clause dealing with dependent personal services, which also provides that the normal income is taxable in the source country where the employees have rendered services or where the employment has been exercised, to be more specific. And the ESOP life cycle and just adds complexity to the manner of taxation of non-resident employees. Yes. So, very interesting question arises is, if ESOPs are given to non-executive directors, and if they don't qualify as employee, as we understand it from a tax perspective, but they do qualify as employees, or they fall within the meaning of the term employee from a Companies Act perspective. So the question arises is, what would be the nature of income that would be payable to the non-executive directors in their hands and whether it would be income from salary or it would be income from other source, or could it be income which is just capital in nature. So to start off with, as I said, from a tax perspective, generally generally what one has seen is that non-executive directors are not full-time employees, and therefore their role is limited in the company, and generally they would not fall within the meaning definition of the term employee as understood under the normal context. So if they don't fall within the definition of employee, section 17 subsection 2 is not applicable, because it would there would be no employer-employee relationship, and therefore the income that may be arising upon the exercise of stock or exercise of options may not be taxable as perquisite. So therefore the question arises is, can it be taxed as a business income, or can it be taxed as income from other source, or can it be said that the income would not be taxable? I would rule out the third option, where income can be said to be not taxable, because section 28 subsection 4 as well as section 56 has a wider ambit within the respective clauses, which says that a benefit or a perquisite arising in the course of a profession can also be regarded as an income in and so far section 28 is concerned, and or under section 56 as the case may be. So if not perquisite, probably this income may get taxed under business income or under EFOS, depending upon whether the ESOPs have been granted in the course of business or otherwise. Again, a very important question that crops up is, what would be the point of taxability? 17 to 6 creates a deeming fiction that the taxability in and so far ESOPs are concerned vis-a-vis employees, that would arise only on the event of exercise, and therefore that deeming fiction is applicable only if there's an employer-employee relationship. For ESOPs which are granted to non-executive directors, therefore the question arises is, would it be taxable still on exercise, or would it be taxable on some other event like vesting or grant? So maybe there are some thoughts which I have which one needs to think about, and also certain considerations that would be relevant. Whether it could be taxable at the time of grant, probably the answer to that will have to be looked at from various angles. But some thoughts or some arguments that can be considered for claiming non-taxability is that at the point of time when the grants are made, there is no vested right to exercise, and in the absence of fulfillment of vesting conditions, typically the options may fall off as well, and therefore at the point of time when the grant is made, it's a contingent right or a contingent asset that one has acquired, and therefore at the point of time grant is made, there should not be, or there ought not to be, any implications in the hands of the non-executive director. If not taxable at the time of grant, can it be taxable at the time of vesting? Again, very debatable question. There could be counter thoughts on both sides. One may argue that a grant, once vested, become an asset for the employee, because now he has a right to exercise and convert into shares at any point of time. And the vesting gives an unconditional right to the employee to exercise the shares. So can it be said that the income has accrued and therefore it would be taxable in the hands of the non-executive director at the point of time when vesting happens? Again, fairly debatable point. While there is a strong argument available that taxability may get triggered at the point of time when vesting is done, because an unconditional right to acquire shares does get created. But again, just as a counter to that, one may also argue that there's a potential that the options may also lapse in the future for various reasons. One of the reasons being option out of the money, or where the employment is terminated for some reasons like cost. So the question therefore is whether the unconditional right to acquire shares is actually unconditional. Probably yes, but it is subject to certain conditions that if certain events occur in the future, even the vested options can lapse, and therefore there may not be any income at the point of time when the options get vested. Very common, or not common, but there have been precedences where instead of exercise of options, there is a buyout of options. And okay, so first, to understand what do you mean by buyout of options. In a buyout of option, there is no allotment of shares. There may not be any exercise, but the options are bought out by the company itself, or by the holding company, or by some other investor, or a new investor who is coming on board. So there could be various reasons why a buyout may happen. Probably one of the reason is maybe that they don't want to dilute the cap table. So therefore, the options may be bought out. The employee may get adequate compensation depending upon the fair value of the options. So in this case, a question arises: in case the options are bought out and not exercised or converted into shares, what would be the tax implication that could arise in the hands of the employee? Now, as I said, Section 17(2)(6) is a deeming fiction, which talks about salary taxation at the point of time when the shares are exercised, or at the time when the allotment is made. And in case of buyout, very technically speaking, there is no exercise of options leading to consequential allotment of shares. The options are cancelled at the threshold itself without consequential issue of shares. So therefore, can one take an argument that 17(2)(6) is not applicable because there is no exercise or allotment of shares pursuant to some event, and 17(2)(6) is not applicable. Very interestingly, the wordings of Section 17(2)(6) are very wide. They use the word directly or indirectly. But having said that, even after using the term directly or indirectly, the term allotment of shares, the condition of allotment of shares may still not get fulfilled. So therefore, a question arises is, if not under 17(2)(6), and can it be taxed under 17(3) or under 17(1) as additional remuneration granted by the employer to the employee, and therefore it will still qualify as a normal income, as salary income. Probably, one will have to take those arguments of whether if something is stemming out from the employment and has roots associated with the employment, whether that could still be taxable under the head salary or not. If taxed as salary income, as I said earlier, the tax rate could go as high as 42% depending upon the slab bracket. But if it is taxable as capital gains, nothing may change. It could be taxed at a lower rate of 20% as well. So what are the arguments that one can take to tax this income as capital gains and not a salary income? So again, laying down certain thoughts. Options give you a right to acquire shares in the future. So therefore, the first question to answer is, are options a capital asset? So there have been host of judicial precedences which have held that options are a capital asset. They give a right, they signify a right, vested right or an accrued right with the employee to acquire shares at a future point of time. And therefore, the definition of the term capital asset, which is wide enough to mean property of any kind, will get fulfilled. So then the question arises is, does a cancellation of option amount to transfer? And if yes, would it be taxable under Section 45 subsection 1? Before I move on to Section 45, I just would want to highlight one specific section, which is 46 capital A, which talks about taxability of Generally, we associate 46A with buyback, but if one looks very carefully, Section 46A is just not restricted to buyback. It uses the word capital gains arising on purchase by a company of its own shares or other specified securities. And typically, in case of a buyback or a cancellation of options, whether it can qualify within the meaning of the term purchase by a company of other specified securities is something which we'll have to look at from the construct or the mode in which the buyout happens. If it does qualify within the meaning of the term purchase, the second aspect that would be relevant is to see whether it qualifies within the meaning of the term other specified securities. And the other specified securities refers to Section 68 of the Companies Act, where the term ESOP is specifically included. So very tricky. 46A is a specific section which governs the taxability on purchase of company of its own shares or other specified securities. So therefore, if the taxability is arising because of 46A, whether even to that extent salary income may not be applicable is something which one will have to debate. And mind you, under Section 10, where exemption has been provided for buyback on any income arising pursuant to buyback, that merely refers to income which is taxable under 115 QA, and there is no reference to other specified securities under 115 QA. So while the buyback tax may not be applicable, so therefore 46A assumes much of a relevance again from determining the taxability on buyout of options. So, really this has to be looked at while taking one view or the other. And as I said in my earlier slide as well, the reasons are obvious. Capital gains is taxable at 20%, whereas salary income is taxable upwards of 40%. Does the situation change where the buyout happens by not the company but the investor? So probably my answer to that would be yes. Things do get changed when there is a buyout by an incoming investor or a new acquirer, because the employer-employee relationship to a certain extent gets diluted or even completely eliminated if that can also be the case, because it's really the shareholder or the new shareholder who is buying out the options, and the money that would be received by the employee would be from the investor and not from the company. So, so the better arguments to characterize as capital gains compared to the first scenario, but again, a very, very controversial issue, and appropriate advice needs to be taken at the point of time before taking a decision. Yeah, and there are several judicial precedents on this aspect now, as this is being seen commonly. And as I said, there could be various commercial reasons, if not tax, why a buyout may happen and employees may get sufficiently remunerated. I'll very quickly move on to just discuss this slide. Until now we have been discussing taxability of ESOPs, where it is taxable at the point of time exercise happens and the consequential allotment of shares. In case of SARs, which are stock appreciation rights, as I discussed very briefly in my earlier slide as well, it could be cash settled or equity settled. And in case they are equity settled, the tax implications remain the same. As we discussed for ESOPs, because ultimately there would be allotment of shares, and Section 17 subsection 2 would be applicable. However, if it's a cash settled SAR, and what do I mean by cash settled SAR? Whatever is the net value of the SAR at the time exercise happens, those are remunerated. The benefit is remunerated in the form of a cash payout. So in such a case, what will happen is it would be akin to additional remuneration or a cash bonus being given to employee at the point of time when exercise happens. So therefore, a question arises: is it taxable under 17(2) as perquisite? The answer to that may be no, because technically speaking, shares are not allotted, and 17(2)(6) being a deeming fiction, probably needs to be interpreted in a strict manner. And therefore, from a 17(2)(6) perspective, at least a cash settled SAR may not get covered, because there will not be any allotment of shares or exercise. There may be exercise event, but there may not be any allotment of shares. Can it be taxed as a salary income under 17(1), saying that this is nothing but an additional remuneration? Obviously, tax authorities would might take an argument that they should be taxed as a salary income, because ultimately the money is being received from the employer. An employer-employee, any income which has an employer-employee relationship should be taxed as salary. A complete counter to that would be that the money that is received by the employee on the event of exercise is not because of the employer-employee relationship. It is because of the capital asset, which is the SAR units or the phantom units that the concerned employee was holding. The income is arising on transfer of that unit, and therefore, if there is any income that is arising, that should be taxed as a capital gains under section 45 and not as not under 17, because the income, though coming from the employer, it is because of a vested right which the employee was holding in the form of SAR units. So in a fairly debatable point, the answers could swing both ways. In the context of a pre-amended 1999 era, where there was no specific reference or a section governing taxability of ESOPs, there is this landmark Supreme Court judgment in the case of Bharat Patel, which has dealt and taken a view that in the absence of determination of cost of acquisition of the units, of the SAR units, there is no capital gains income under section 45. So probably some reference could be drawn from that, because since that dealt with a scenario at before 1999, where there was no specific reference to any section determining taxability of ESOPs or SARs. Very quickly, we'll move on to having understood a myriad of issues when it comes to employee taxation. Just to summarize on the two major issues would be the characterization of income as salary income or characterization of income as capital gains. Salary income would be taxable at a higher rate. Capital gains potentially could be taxed at a lower rate. So the debate will continue depending upon the nature of instrument, the nature of transactions that are implemented to achieve the end result. And one will have to really look at all the facts and all the aspects, commercial aspects, clearly before arriving at a conclusion or a reasoned analysis of what should be the appropriate view. In the hands of employer, again, it is not so simple. There is no specific section which governs allowability of ESOP expense. The law has more or less settled pursuant to certain court precedences, and therefore it has taken quite some time for the law to settle on this. And as we are speaking even today, one of the judgments is pending before Supreme Court for adjudication. But until now, fairly the dust seems to be settled in spite of the pending Supreme Court litigation. And the reason for that goes back to the fundamentals of determining whether an expenditure is a revenue expenditure or a capital expenditure. So I'll not take much time here. I'll just summarize it. The tax authority's contention has been that the expenditure that is issued on grant of ESOP is a capital expenditure because that involves issuance of shares. And the taxpayer's argument against that has been that while determining whether the expenditure is a revenue expenditure or a capital expenditure, one really has to see the services that have been availed for determining whether they are revenue or capital in nature, and not the mode of payment. And issuance of shares pursuant to exercise of options is merely a mode of payment for remunerating the employee, and therefore, while determining whether the expenditure is a revenue expenditure or a capital expenditure, it is the services, the underlying nature of services that has to be looked at, and not the mode of discharge. So that there's a very solid argument available to say that this is a revenue expenditure, because ultimately it is a mode of remunerating employees and not it is ultimately a means to remunerate employees, and issuance of shares is just a mode of discharge. The next question, if it's an expenditure, when does it accrue and over what point of time will it be allowed, especially considering the life cycle of the ESOP, where it ranges from the grant date till the exercise date. So there again, accounting standards come in very, very handy, read with the guidance note issued by the ICAI on how to do accounting for ESOPs. And a fairly scientific method, and probably one of the best logical method that has been prescribed by the accounting standard and the guidance note issued by the ICAI, which says that in case of ESOPs, the fair value on the date of grant needs to be amortized over the vesting period, because it's not a period cost. It's not a one year period cost. It is a cost which is incurred over a period of time, and therefore even from an accounting perspective, you follow matching concept, and based on matching concept, you amortize it over the vesting period So if that is the case, the simple concept, as we all know, tax follows accounting unless otherwise unless the context otherwise requires. So therefore, from a taxability or from an allowability standpoint as well, the question of when will the expenditure be allowed could probably be traced to the accounting, where it could be amortized over the vesting period, and the amount that is amortized over the vesting period should be eligible for deduction. And obviously, the last aspect which needs to be dealt with is, can somebody say that this is a contingent expenditure until the point of time the options are exercised, and it is only on the occurrence of the event of exercise that the expenditure will get crystallized? The answer to that would, in my view, would be in the negative, because it's not a contingent expenditure. It's a provision made based on a scientific basis, based on the method provided under the guidance note in the accounting standards. So very much within the permitted purview. And as we all know that an expenditure which is made, a provision which is made on a scientific basis, cannot be considered as a contingent expenditure. It should qualify within the meaning of the term provision. So a small example which I have tried to give to just complicate things and add a new dimension or a perspective. We all know that, while I have not discussed the accounting, but fairly from an accounting perspective, as I mentioned, it is the fair value on the date of grant, which is amortized over the vesting period. So a small example, say at the time of grant, the FMV of the option is 100 and the exercise price is 90. So in a very, very layman terms, one could say that option is in the money because even if I exercise it today at 90 rupees, I can sell the shares at 100 rupee and 10 rupee ka mujhe gains ho jayega, right? Assuming that this is the fair value of option based on the accounting principles as well, this 10 rupee is what would be amortized over the vesting period. And if the vesting period is 4 years and it is amortized on a straight line basis, 2.5 would be eligible each year as a deduction based on what has been debited in the P&L. Let's say 4 years later or 5 years later, the exercise happens, and on the exercise, the fair value of the equity shares is 1,000. And obviously, from a taxability from an employee vis-a-vis employee is concerned, it would be taxable to the extent of difference between the fair value on the date of exercise, which is 1,000, and the exercise price, which is 90. So 910 would be the amount that would be taxable in the hands of the employee as a perquisite income. So therefore, the question arises is, if 910 is the income which is taxable in the hands of the employee as salary income, what would be the amount of deduction that the employer can claim? Now, if you analyze it very carefully, from an accounting standpoint, only the fair value on the date of grant, which is 10 rupees, was amortized over the vesting period. The balance 900, which is though an income for the employee, is not or has never been debited to P&L because of the accounting guidelines that have been prescribed. So therefore, the question arises is this 900 also eligible for deduction in the hands of the employer, considering that this is nothing but a benefit that has been given to the employee, and therefore it should be allowed as a deduction. So 2-3 hurdles that one will have to cross. First is this amount has not been debited to P&L in the books of accounts. So probably from a tax perspective as well, the first hurdle that needs to be crossed is that if the amounts are not debited to P&L, whether they can be claimed as a deduction. To that, the answer would obviously be in the affirmative, that there have been host of judicial precedences, including the Supreme Court judgment, which have said that entries in the books, though act as a starting point, are not conclusive in determining the tax implications, and one has to see tax implication on a standalone basis as well. Once that hurdle is crossed, if there is no expenditure debited in the P&L, the second aspect would be, is it a revenue expenditure, and whether that can be claimed as a deduction. So, there's a landmark judgment of the Bangalore special bench in the case of Biocon Limited, where this specific aspect has been discussed at length, and the Bangalore tribunal was of the view that the amount of expenditure, though not debited, which in our example is 900, can be claimed as a deduction on the event of exercise. Since this looked at it from a commercial perspective, this represents an actual expenditure, because it's actually from a company's perspective, the value of the services that it has availed. It is 1000 minus the amount that it collected, that 90, and 910 should be the expenditure that should be allowed. And since 10 rupee expenditure was already allowed as a deduction, the excess 900 rupee, which reflects a true up expenditure, should be allowed at the time of exercise. So this specific aspect has been dealt with by the special bench in the case of Bangalore special bench in the case of Biocon. There was a subsequent judgment of the High Court as well on this assessee, but the specific aspect of true up expenditure was not challenged or discussed in that judgment. And the law as it stands today, SLP has been filed, but again, the question of law before the Supreme Court does not involve whether the true up expenditure would be allowed as a deduction or not. So probably the Bangalore special bench judgment as of now could be considered as a binding verdict, and the principles of that judgment may be relevant, if not directly the judgment. And one can try and argue based on the principles laid down in the Bangalore special bench to take a view on the eligibility of true up expenditure. Vis-a-vis deductibility in the hands of the employer is concerned, from a SAR perspective, things become fairly straightforward because it's a cash payout. And if it's a cash payout, it should be eligible. The controversy becomes lesser because it's the actual amount that is paid in cash that generally would be allowed as a deduction. And while determining whether it's a revenue expenditure or a capital expenditure, as I said, the arguments that you see the underlying nature of services that has been availed and not the mode of discharge. However, things can get slightly complicated in case of SaaS, especially where a view is taken by the employee that in his hand it is a capital gains income, and therefore if a view is adopted, whether that has any impact from the characterization of income from an employer perspective, the answer to that also probably may be no, because it's a so to say a fairly settled principle that tax implication in the hands or characterization of income in the hands of other assessee does not impact the characterization of income or expenditure qua the payer. So probably that could be the argument that one will have to explore, but things can get a bit complicated if divergent views are being taken vis-a-vis employer and employee. So yeah, again, too much of tax done now. Last section before we close and open the house for questions. are the regulatory implications. And again, I'll very quickly wrap up this because these are more compliance related. Not much to discuss vis-a-vis any substantive provisions. I've just highlighted few substantive provisions which are relevant. But other than that, is merely compliance and approval that need to be taken. But for completeness purpose, one needs to be aware of what are the rules. So from a company law standpoint, 2-3 quick points. Issue of options requires a special resolution by the shareholders. It's but obvious because it's ultimately the shareholders, existing shareholders, who will get diluted, and therefore their approval by a special majority, not necessarily an ordinary majority, is very, very important and obvious. Under the company law in India as well as SEBI regulations, there is a minimum vesting criteria which says that the vesting condition should be at least 1 year. So you cannot have an option which have vesting condition or a vesting period of less than 1 year. Options generally are non-transferable, and the law is completely flexible in and so far determination of exercise price is concerned, as also the determination of lock-in restrictions, if any, once the option have been exercised and converted into shares. In scenarios where the employee leaves and the employment is terminated, again, the law is very flexible that it would be governed in accordance with the ESOP plan that has been framed. So ESOP plan from a documentation perspective becomes very, very critical, which governs the contours of the modalities for operation of the ESOP, and which covers several aspects several practical aspects in and so far the governing principles are concerned. So to summarize, not much guidance is available from a company law standpoint. It has been left to the ESOP policy document and the respective companies to frame the policy that they want to frame in accordance with what is considered best. Just high level guiding principles in terms of vesting condition, in case of termination, in case of death, etc., where certain guidance has been given, but by and large it would be governed by the ESOP policy, similar to what we have seen in partnership firms, that generally the partnership deed governs the modalities of the partnership engagement. From a SEBI perspective, it would be applicable when the company is a listed entity, and apart from the basic differentiation that we discussed on the meaning of the term employee under SEBI regulation as well as under the company law, there are certain other regulations also that one needs to be factored, especially considering that the shares would be listed security. So other regulations vis-a-vis automatic listing of securities upon exercise also become applicable. More so, again, as I said, from a procedural standpoint, not so much relevant from a substantive standpoint, because these are something which one needs to be doing in due course of the practice. The minimum vesting condition of 1 year continues to be applicable even in case of ESOPs under the SEBI regulations. And again, a special resolution needs to be obtained in case where ESOPs are to be granted to the employees of the subsidiary company or the holding company. Once the shares become listed, one also has to be mindful of the insider trading regulations, because employees who are generally will fall within the meaning of the term connected persons in and so far SEBI regulations are concerned, and they may be privy to certain information which the public at large may not be privy to. So from an employee who is holding ESOPs and consequentially shares of a listed company, the thought that I want to lay on from this slide is that there are certain compliances and checks and balances that one needs to ensure from an insider trading regulation standpoint as well. Example could be in the form of a pre-clearance that needs to be obtained, or certain restrictions that may be there from a contra trade perspective, and several other protocols that one needs to follow in accordance with the insider trading guidelines. So when we are dealing with shares of a listed company held by employee, PIT regulations also become relevant. And the last would be obviously ICDR regulation dealing with issue of capital and disclosure requirements. This is more relevant in case of pre-IPO ESOPs which have been issued, whether they could be tendered during the OFS. OFS would mean offer for sale. And if not tendered for OFS, what are the lock-in restrictions that are applicable or that would be applicable to the shares that are held by employees. So that aspect becomes relevant, which I have discussed in my slide, and I'll not be discussing it further for the time being. Yeah, that brings us to the last section in insofar regulatory provisions are concerned. I'll spend some time on this because this is important. FEMA inbound regulations and FEMA outbound. From an inbound perspective, the structure is very clear that the non-resident employees are being given ESOPs or employee stock option units of the Indian company. So from a FEMA perspective, it's an inbound investment or potential inbound investment where the employees, non-resident employees will be investing or holding shares in the Indian company. So general provisions that are applicable from a FEMA perspective, the shares when are issued to non-resident need to be issued at a minimum of FMV to comply with the pricing guidelines, and capital account transaction in and so far shares are concerned are specifically permitted under the NDI rules, popularly called as the FDI guidelines or FDI rules. The exception to issuance of shares at a fair market value, one of the exception to that is ESOPs. Shares when one of the exception to that is issuance of shares pursuant to ESOPs where pricing guidelines are not applicable as long as the ESOP has been framed in accordance with the Companies Act or the SEBI regulations as are applicable. So this is one exception where pricing guidelines are not applicable. The next question is, would the investment be under automatic route or would it be under the approval route? The answer to that also depends upon the company in which you are investing. If the company in which you are investing is otherwise under the automatic, is otherwise eligible to seek investment under the automatic route, then even the ESOPs would qualify as automatic route investment. And in case the company is engaged in sector where prior approval of the government or RBI is required, then in that case, even issuance of ESOPs and consequential allotment of shares would be under the approval route. From a compliance perspective, certain basic compliances like Form ESOP, Form FCGPR, etc., need to be filed on a time-to-time basis to ensure that the adequate reportings are done to the AD bankers for issuance of options and subsequently on the allotment of shares. Outbound regulation, very exciting recent amendment that were made by August 2022. A lot of clarity has been provided. Again, from an outbound perspective as well, the guidelines are very clear that Indian resident can hold shares under an ESOP scheme of a foreign company. Earlier there was this debate upon what is the quantum that one can make, quantum of outbound investment that can be made under the overseas investment rules, whether LRS would be applicable, not applicable, etc. So to say, the guidelines now do provide some sort of clarity. First is that these investments will be qualified as an OPI investment. OPI stands for overseas portfolio. I will not get into the technicalities of what is ODI, what is OPI, etc., because that requires a separate discussion. The second aspect which would be relevant is the quantum of investment that can be made, whether it would be restricted to the LRS limits or whether it would be it can be done over and above LRS limits. So it's very funny the manner in which, not funny, it's so to say very clear in the way in which the rules and regulations have been drafted in and so far ESOPs are concerned. But there are some divergent views that are prevalent among the AD bankers as well. But the popular view on that front, as we understand, is that the LRS limits would not be applicable vis-a-vis investment in ESOP scheme of a foreign company. There are certain conditions like which have to be fulfilled, as has been mentioned in the overseas investment rules. That will have to be fulfilled to ensure that the investment is under the automatic route. Yeah, from an indirect tax perspective, fairly straightforward. GST is not applicable on any services provided by the employee to the employer. So in and so far issuance of stock options to employees are concerned, there should not be any GST implications because that will not qualify within the meaning of the term services. Vis-a-vis non-executive directors who are not employees, potentially there could be certain GST implication which one will have to evaluate from a reverse charge basis. Yeah, I think the accounting implications very broadly I'll touch upon. We have already discussed that. It's there are Ind AS regulations which are applicable, Ind AS 102, which governs which provides for guidance on ESOP accounting. In and so far those companies where ESOP where Ind AS is applicable, and then for those companies to whom Ind AS is not applicable, we have the guidance note issued by ICAI which provides for detailed guidance on the manner of accounting for ESOPs. As we discussed in our earlier example as well, the ESOP accounting is based on fair value concept, and the fair value also should be based on the date of grant and not any other event. So the fair value of the options and the date of grant is amortized over the vesting period and appropriately claimed and debited to the books of accounts. So broadly, this is the accounting implication. Obviously, there will be very detailed nuances and circumstances that may arise because of various events that can occur during the ESOP life cycle. For the sake of brevity, at least for this presentation, I have not covered that. Maybe that requires a separate and a detailed discussion, and it is a topic in itself. Yes, so finally that brings it to my last slide. And for those who would have already logged off or gone to sleep, I think now we can officially wrap up the session and take up if there are any questions that maybe that the group has.
Yeah, thanks, Parth, for this wonderful presentation.
Do we have any questions, and what time do we have for the questions? How much time is left?
Questions are not much. I mean, participants, if you have any questions, please post them in the chat box. We have about 5 to 10 minutes for Q&A. And till now, only 2 questions have been posted. I think you have covered those questions, but we can just have a quick recap. One is it necessary to have shares valued on the grant date?
So from what perspective? Accounting, is it an accounting question? So see, I'll maybe try and answer it that from an accounting standpoint, what you need to do is you need to value the options to determine the accounting hit that would occur over the vesting period. And valuation of options involves 2 models. One is called as the Black-Scholes model, which is a fairly complicated model. And the second is the intrinsic value method, where you determine the value of the options based on the difference between the fair value on the date of, based on the difference between the fair value of shares and the exercise price. Under the Ind AS regulations, only the fair value method, which is the Black-Scholes method, has been recommended. Intrinsic value method is not permissible, and same goes under the revised guidance note as well. Only the Black-Scholes model is applicable. So what you essentially need to do is determine the fair value of options on the date of grant and not the fair value of shares. Obviously, fair value of option will get its value from the underlying security which it is representing, which is the shares. But very technically speaking, shares do not need to be valued at the time of grant.
Okay. But for that exercise price, will the shares need to be valued at the time? Let's say you join the company today.
Yeah.
So
Yeah. So obviously at the
companies,
time of exercise. Yes, Ashay. So at the time of exercise, there's a taxable event that is occurring, and the taxable event is determined. The tax charge is the quantum of tax is the quantum of income is determined based on the fair market value of the equity shares and on the date of exercise. So yes, you need to value equity shares at the on the date of exercise. Under the income tax law, detailed guidance has been given of how do you value the equity shares. Just to summarize, in case of listed securities, the fair market value will be based on the ruling market price on the date on which the exercise is happening or the shares are allotted. And in case of an unlisted company, you need to obtain a valuation report from a merchant banker, which will determine the fair value of equity shares on the date of exercise.
Okay. The next question is, if employees exercising the option after leaving, if employees exercising after leaving company, then how withholding tax by employer condition will be met in case shares are allotted?
Yes. So very interesting question. So from a 17(2)(6) perspective, if it is ESOPs, the wordings is very clear that it says any benefit or a perquisite arising from an employer or a former employer. So in and so far employee is concerned, the taxability would still be under 17(2)(6) itself because it uses the word former employer as well. So the income would be taxable as salary only, even though the employee would no longer be associated with the company. As under income under 17(2)(6). So obviously a consequential and an important question arises, how do you do withholding? Because now there would be no other income that would be payable to the employee. So how does employer ensure that the withholding has been done or it is being done, especially in case it's a non-monetary benefit? So the answer to that is that typically it would be mentioned in the ESOP agreement or the grant letter that the exercise can be done only at the point of time when the employee pays the exercise price and the perquisite tax cash amount, because ultimately it is the employer cannot go out of pocket under this scenario and he will recover the TDS amount from the employee before allotting the shares. But this would be governed under the contractual obligations as a part of the ESOP grant letters.
Does cancellation of options amount to capital gains?
So I think we discussed enough on that.
We have discussed, yes.
Yeah, we have discussed enough on that.
So let's move ahead. Just a minute. What is the section under which valuation of shares to be done for the purpose of taxability in the hands of employee on allotment date?
It's Rule 3, Sub-Rule 8 of Income Tax Rules.
Yes.
Read with Section 17, Subsection 2, Clause 6.
Taxation on trust root versus others.
Yeah, so as I discussed, in one slide briefly, it is trust model is fairly complex. From an employee standpoint, they would not make any difference when the shares are allotted either by the company or from the trust, because as I said, the 17(2)(6) is wide enough. It says any benefit or perquisite arising to an employee directly or indirectly from an employer or former employer. So directly or indirectly, the words indirectly are wide enough to cover grant of options and consequential allotment of shares under the trust route as well. So employee standpoint, nothing changes. From an employer standpoint, there are a lot of complexities which will arise vis-a-vis deductibility of expense, vis-a-vis consolidation of trust into the company, and several other things that may be associated at the time of setup of trust and at the time of transfer. So trust in itself is a separate complicated aspect, and there will be various nuances around it, which is generally associated in a trust taxation that would arise for an ESOP trust as well.
There aren't any other questions, Parth. So one question which probably you can advise us is if we mentioned in our initial slides that ESOPs cannot be granted to a promoter or a
Yeah.
promoter group. So who is a promoter? Like for example, once a promoter, always a promoter concept, even if let's say 90% of his company has been taken over by someone.
No, so from a Companies Act standpoint and SEBI regulation standpoint, the definition of promoter has been given under Section 2. So it is, there are three parameters that have been mentioned for definition of the term promoter. One who identifies himself as a promoter suo motu, one based on certain rights and stake that the person is holding, and other is again, a discretionary criteria. So definition of promoter is based more on the intent rather than the position, I would say, to summarize it. And there have been cases where even if, say, a person is holding more than 50%, he may not qualify as a promoter because he may choose to not be qualified as a promoter. At the same time, there may be a person who would be holding only 5%, but he may be characterized as a promoter. So promoter classification, reclassification is permitted. That is answer one. That depends upon certain guidelines, both under the SEBI regulation as well as Companies Act. SEBI regulations are more strict because it's ultimately the listed shares which are getting affected. So reclassification is subject to certain conditions and prior approval of SEBI. From a company law standpoint, the things are a little bit straightforward. Classification of a person from non-promoter to promoter or vice versa is permitted, but that will be again subject to certain conditions. That would be my first answer. Second answer is if for some reason a person has been reclassified from promoter to a non-promoter, so then technically speaking, ESOPs can be granted to that non-promoter as well. And we have a live example which is available in public domain. I don't want to name any company, which is a very, very valued startup where some of the founders reclassified themselves as non-promoters before IPO so that the ESOPs could be granted to them. And there have been enough and more examples about such aspects getting discussed at length to ensure that whether ESOPs can be granted or not. But the answer is very straightforward. ESOPs can't be granted to promoters. If you classify yourself as non-promoter subject to approvals and conditions, technically speaking, ESOPs can be granted to you at the point of time when you are a non-promoter.
Okay. Thanks, Parth. I don't think there are any further questions. I request Hetal to, give a vote of thanks.
Yeah. Thank you, Ashay. Before giving this before doing this VOT, let me just pass over a comment to you, Parth, from one of our participants. And it says the presentation was very detailed and professional. And indeed, you are a very knowledgeable speaker. So he's expressed his gratitude for the same. Now, coming to the pleasant task of giving the VOT to you. I'm sure everyone will agree that we had a very young and a dynamic speaker today in our Youth Excellence Symposium-13 on the topic structuring of ESOPs for key employees. Parth has given us a 360-degree view. He has deep dived into each and every aspect of it. He's tried to cover the entire framework in this given span of time, not leaving anything, be it FEMA, be it Companies Act, SEBI, taxation, you name it, and it was there in his presentation. It was very crisp and very, very simple to understand. Like we had three aspects in the ESOP: grant, vesting, and exercise. Let me put this gratitude to you in this manner that we've been granted the benefit of gaining knowledge the moment we decided to be on the session today. We've been vested with an excellent knowledge by our speaker, CA Parth Savla, with his lucid presentation, and he's given us his deep diving insights on the topic. And hopefully with this vesting, we'll be able to exercise this knowledge in our daily practice and try and excel in our profession. So with this words, Parth, thank you for your knowledgeable insights, for giving us time and sharing the topic in a very lucid manner. So So I think all of us are going to take a lot of learnings home today. So on behalf of Women and Young Members Excellence Committee, I formally express my gratitude. Thank you, Parth, for a wonderful session that we had today. Thank you all the participants as well
Yeah, just some closing
for your
comments from my
attendance.
side as well. Sorry, just I'll take 60 more seconds. I think, Hital,
Yeah.
thank you for the kind appreciation. Just sharing and transferring a little bit of experience that I've had on working on ESOPs over the last few years. I thank the ICI again, once again, for providing me an opportunity to share my thoughts. And I would also like to thank my colleague, Kajal Manvi, who has helped me in putting up this presentation. And to all my earlier principals whom I have been associated with, from whom I have learned deeply about this subject, and the client with whom I have worked with, who have provided me practical insights and practical situations to deal with different aspects of ESOP.
Yeah. So thank you, Parth, again. And
Yeah. And to
thank you all
those
the
who have asked me
participants.
to whether this presentation would be shared, yes, I'll be sharing this presentation. So maybe you can get in touch with the conveners to get a copy of the presentation.
Yes. So we
Thank
can
you
end the
again.
session now. Yeah. Thank you, Parth.
Yeah.
We can end
Okay.
the session.
Yeah. Okay. Thanks.